In today's video, we are going to analyze Novo Nordisk, which is Europe's most valuable company, which I used to own, but I have sold. And if you stick to the end of the video, you will get a full picture why this company will shape our future. So if you haven't heard about Novo Nordisk, the company basically designs, manufactures, and sell diabetes 1, diabetes 2 medicines. And this one is a crucial industry, and the company has been operating for more than 100 years. Right now, I am inside our stock valuation Google Sheets, which you can get through the description if you click on the link, and this will help you to analyze stocks and determine their price value. Of course, by using this tool, you can get a full picture about the company. So today I have put NVO, which is the ticker symbol of Novo Nordisk, and we got a 10-year plan of their financial analysis where you can see their revenue, gross profit, and much more. But we are going to start with the sixth line, which is the revenue, and we can see that Novo Nordisk was able to double their revenues over 10 years of period. It's very important that this analysis is in Danish crowns currently, so we have to exchange it into the dollars when we are going to do it, the discounted cash flow model. And we can also see that the company's gross profit has also been increasing. This means that the company can make even better margins, and also we can see that their operating income has been increasing also, which will make them a very profitable company. As we can see that in the 10 years period, they could also double their profitability, which is extremely good for a value investor. So we can basically see that their net income has been increasing from 2014, making them a more profitable company. And what is very interesting, and I like, if a company is continuously buying back their shares, and if we go into the line 21, we can also see that the company has been reducing its outstanding shares for more than 8 years now, and we can see that with a very nice numbers in the 22nd line, it has been reducing the outstanding shares, which is good for price appreciation. And also, if we look at the free cash flow, which is one of the most important, and we are gonna go to a deeper dive in it. If we look at their free cash flow, which is maybe the most important in today's video, we can see that it has been increasing very nicely. This is exactly what I would like to see in a company like this. So in general, the company has been performing very well. And if we go to the right side, we can see that the PE ratio is around 43, which is quite high for a company. The profit margin is excellent. We can see that it's 35%. The current ratio is a little bit below 1, which is all right. And their debt to equity, long-term debt per equity ratio is also very, very low. This could signal that the company's health is very great. And we can also see their price to free cash flow is quite high. As I said before, the company can generate very nice free cash flow over the years. And this will help us to make it easier to assume what is going to be the real price of the company. And then let's check the dividends. Of course, it's very important. The company is not paying out a huge one, but you can see that there is 1.3.5%, which could still lead to a very nice dividend over the years. And if we look at the EPS is also going to grow, which really shows that the company is still growing and it has the markets to conquer. And now we are going to take a look at the discounted cash flow analysis, where we can see that the company could generate very nice free cash flow, and we are going to draw that up for the 10 years. So I have put in the data from 2024 until 2023, and we get that they could grow by an average percent of 11%, which is extremely good. And I'm going to forecast this free cash flow growth for the next 10 years with an 8% growth rate. And this will help me to see what is the value of the future free cash flows. And I will take it back to the present value with a discount rate, which I use 6.5, which is the analysis targets. So I think these numbers are very realistic, a little bit conservative with 8%, so maybe I could use 9 to be a little bit more positive. But we are going to just input the cash and cash equivalents of the company, which is a very nice, great cash position. And then as we can see, they have much more cash than long-term debt. And now this one is in US dollars. The previous analysis table was in Danish crowns. And we can see that their equity value is quite nice. And then we just put in in the shares outstanding, and we will get that the average share price should be around $87 per share. If we take a look at what's the current price of Novo Nordisk, we can actually see that it's $105, so it's a little bit higher than the discounted cash flow model shows. But as I mentioned previously, there is a little bit issue, or I would say that the company is very much high priced in. We can see that their current PE ratio is 44, and then the forward rate is going to be around 40. So 40 is very high in regards of a PE ratio, especially that we are looking at an environment that most of the stocks are a little bit overvalued, but we can see that the company's value have raised over the year. 1 year they have grown 50%, which is quite significant. If we look at the 5-year chart, we can see that the company has been growing in regards of the stock price. And what we are going to look at it also, what have it done against the S&P 500. If we look at a company, we should measure it accordingly, and the best way is to do that is to take it to the S&P 500 and see how have it done against the S&P 500. So we can see that Novo Nordisk in 1 year could perform 52% in growth. S&P 500 could only do 23%, and I would just put this 23 in a column, so 23% is a very nice growth. If we look at the 5 years, we can see that basically Novo Nordisk could overgrown the S&P 500, so it could perform 400% over the 5 years, and the S&P could only do 100 again. Only is in like the cat palms, I don't know how you say it in English exactly. But if we look at the 10 years, which is really the most favorable one if you're a long-term investor like I am, we can see that 554% growth is like extremely great. Just imagine this is a 5-bagger for you if you would invest in this company and you would just hold it, while S&P 500 only would get you 229%. So Novo Nordisk in general is a very nice company with a cutting-edge technology, and it has been developing their markets and becoming the biggest company in the European Union, which is amazing. But I would say that at this price of 40 PE ratio, I wouldn't be able to touch it, and this is why the most reason I have sold it. So I was holding it basically from 2021, and as it was growing, I decided to sell it because at this point I feel like the company is extremely overpriced. Even though it's growing significantly, the market has been showing that the company's product is great. Basically, they are always sold out from their diabetes 1 and diabetes 2 products. But I'm just saying, like, I'm not willing to pay this much at premium at this point. But of course, it's on my watch list, and I'm going to watch how the company goes over the years. And if it gets a little bit cheaper, I would be very interested in the company. So thank you for watching. This was my first video on this channel. I have been doing all of this in Hungarian, so it was a little bit confusing me at the beginning. If you would like to see similar videos, feel free to subscribe to my channel, and I will get you in the next video. Oh, and I just wanted to say, and if you would like to get a stock to be analyzed in the video, please share it in the comment section, and I will make sure that you will get a great stock analysis in the next video. So see you in the next one. Goodbye.